Welcome to Scope's Portfolio Manager Conference. My name is Manqing Sun, mutual fund analyst from Scope Analysis. For this session, I'm very pleased to be joined by our guest speaker, Mark Hawtin, investment director at GAM Investment Management. He's joining us on the line today from London. Welcome, Mark.
Hi, nice to be on.
Our discussion today will tap into growth stocks that are focused on world's most disruptive technologies in the tele-everything world, where workplaces, healthcare, and social activity improve. During the session, we will cover questions that's been on investors' mind recently. For example, concerns of inflation and interest rate rehike, the impact of supply chain bottleneck and chip shortage, the prospects for earnings and valuation, and also about the development on regulatory resets of Chinese tech companies. I'm also going to ask Mark to share, look into the crystal ball and share his take on trends where investors should at least be mindful of when searching for innovation alpha in the year of 2022. Before we begin, I'd like to remind you with few logistics of a webinar replay will be made shortly after the live event. You could watch the clip on our website at any time you want. And also, we'd love getting your questions, so keep them coming throughout. We'll do our best to answer as many as we can. Without further ado, let's jump right into it. So, Mark, I know you've been in the TMT sector for a really long time. Could you maybe share a few words about yourself, your role in GAM, and background relevant to the asset class in particular?
Absolutely. So I've been investing in disruption and technology for well over 20 years now. Former to GAM, I was with one of Europe's largest hedge fund businesses running a long-short technology, media, and telecoms fund. I've seen a huge amount of change over that time. I've had the privilege of meeting some of the great entrepreneurs of the last 20 years. And I think that what's fascinating for me is that each iteration of disruption and growth is more and more dynamic than the last. So rather than thinking that we're towards the end of these disruptive changes, I would argue that we are at least no more than halfway through and maybe even earlier. So there's still plenty more to go for.
So we are actually doing the PMC in a good time in the U.S. market. So sharp drops last Friday, mostly dragged by tech stocks. Nasdaq was closed down by 2%. What has been riding on that? Is it new Omicron variant? Is it Fed's hawkish signal of inflation? Is it earnings or correction on the overvalued?
Okay, so I think that the Omicron variant has acted perhaps as a catalyst,
Mm-hmm.
but I don't think it is by any means the reason. I think the biggest issue is the change in Fed stance. They've clearly turned a lot more hawkish. Um, they are, pushing ahead with closing down the money printing, regardless of the market at the moment. And in spite of what we've seen in terms of interest rates and inflation. So I think the backdrop is much more hawkish than it has been.
Mm-hmm.
We've seen probably the end of lower interest rates. They may take time to go up. There's a concern about inflation clearly. I think the rate of change of pace of things like earnings revisions is probably the second derivative is probably coming down. So when you put this together, I think what is happening is that the market is looking at the parts which have been driven most heavily by the lowest of interest rates and just realigning. So let's say, take for example, software as a service is a sector we really like. It has been hit very, very hard over the last few weeks. A company, DocuSign, is a great example. They downgraded their revenue growth for the next quarter on Thursday night by just 2 percentage points from about 30 to 28%, and the stock fell 40%. So there's a reevaluation of risk. There is no change to the outlook for these businesses, in my belief, or the outlook for the disruptive opportunity. But there is definitely a change and a reevaluation of what one should be paying based on what the risks currently are.
Mm-hmm. So funny that you point out the DocuSign. This is next question I want to ask you. The interesting point coming out of last week's market tumble, including the sell-off, is that the worst performers are mostly stay-at-home stocks, which benefited most from the pandemic and ensuing lockdowns, like DocuSign, like DoorDash, Zoom, Etsy. So this happens during a time where the new variant news just came out. So normally you would expect the market to react in opposite way. But apparently people are betting that, no matter what happens, we are done with the lockdowns. Do you agree with this view? Perhaps a follow-up question to that. What do you think is the largest driver in terms of change in the market sentiment currently?
Okay, so I don't entirely agree with that. So I
Mhm.
think that we've had this mantra for the last 18 months. We've had these very clear um, playoffs. So stay at home versus reopening, growth versus value, long momentum versus short momentum. And these have tended to play out pretty clearly based on where investors or the market thinks we are in terms of COVID and reopening. I think we've seen a very clear change driven by the change in policy. And that is what has driven a very different approach. And that's why these companies, which are probably were probably very overvalued, have started to sell down regardless of where we are. The market is not telling us that we're over with COVID at all. It's saying that's not the most relevant point anymore. Policy is.
So as for the technology, as for the innovation, not every technology or innovation could be tagged as disruptive. So that being said, how do you define disruptive growth? Is it just another way to invest in growth stocks, chasing high momentum? What is the appeal for that? I'm hoping that you can give a sense in terms of investable universe of companies. What's that look like in your portfolio? And I'm also curious what the country and sector composition looks like in your portfolio.
Okay, so I don't know if is it possible to see the slides now that I've just brought up?
Yes.
Okay, so essentially, I think what's important here in the way that I look at things is I look for themes that are being disrupted and
Mhm.
areas of disruption. And one of the biggest disruptive themes, which has been going on for 50 years now, is digitalisation. So here is a chart which you can see showing what I view as four distinct phases of or waves of innovation. The first was the mainframe era with thousands of devices, back in the 60s, through the client server era when we had desktops, um, connected, wired connections, and reaching about 400 million devices in total globally. And then, of course, we had the smartphone era, and that led to a whole new wave and the kind of creation of the platform economy. Things like Amazon, Google, Facebook, these companies could not have existed before we had those devices, billions of devices in our hands. And now we're moving into this next huge phase, which I call the Internet of Everything. It's the connectivity of everything. It's driven in a flywheel effect by connectivity, by AI, by data, with trillions of connected devices. And this starts to impact sectors that have been less impacted to date, things like healthcare and industrials and fintech and transportation. Um, and this is not about hype. This is about very, very clear, very large trends, and then finding the right ways to invest in those trends whilst keeping, certainly in the way that we do the work, keeping a very clear basis in valuation. So we do not own Tesla, not because we don't think it's disruptive, but because we think it's way too expensive. So you get the trend, you get the disruptive uh, theme, but then you've got to invest on the basis of valuation as well.
Mhm. So speaking of valuation, I think one of the, oh, sorry, can you hear me?
Yeah.
Okay, great. So, so the biggest question facing growth stocks, and you mentioned about the valuation, is whether the elevated valuation is there to stay after so many years of bull market. So, on the one hand, we have many bellwethers breaking out to new heights, this year we see excess liquidity out there. We see consumer saving, whether it's consumer savings or corporate cash level. On the other hand, if we take Peter Lynch's rule of 20 into consideration, where market-wide PE plus inflation should equal about 20 to be fairly valued market. Here we got PEs way above 20 on forward and trailing basis. So now there's been a change in the narrative about inflation that goes beyond transitory. Is this the time when valuation is coming down, or would that break the historical relationship in inflation and multiples?
No, so I have to say I'm much more of a believer in intrinsic valuation methodology. So there are rules. There are the rule that you've just cited. There's the rule of 40 for fast growing companies, that growth rate plus operating margin should be greater than 40. I don't really put a lot of stall in those rules. What I think is far more important is to look at the intrinsic value of a business, to model it out, look at its potential cash flow generation over many years. And one of the most difficult things about the world we live in today is that business models are very different. If you're a software company, you don't sell huge licenses anymore. You sell subscriptions. And so when you get to the end of a year in a subscription software business, you start the new year essentially with the same business as you ended the old year with. So January is going to give you the same revenue as December, and then you build on top of that your new growth. But what happens is you get 20 to 30% growth in a good business for 25 years, not hyper growth for 3 years and then a fast tail off. So the methodology that investors need to use is very different. And this is something that I think is often misunderstood. So for me, we do the modeling, we look at what we think the company is worth intrinsically, and that's how we derive whether we think there's opportunity or not.
So as we are approaching year end, do you see some pressure for active management to chase performance, given that the market has done so well this year? Do you see a narrow in the market fear of missing out more than fear of losing serious money?
I don't have a strong view on that. I think that it's been a relatively typical year in terms of the proportion of managers that have outperformed key indices. So, I think there will be those who've done well who will be wanting to take some risk off. Those who have done less well might want to try and chase performance. Um, I don't really see any reason why we shouldn't see a relatively seasonal, unusual move higher into the year end, the last week or two of the year. What happens over the next week or so will probably be molded a little bit around the news flow on the new variant of COVID. I think what's much more interesting is what happens next year, and I think what's important about that is that we've given the system a clear kind of reset. So I think fundamental work will pay off a lot more than it has done in the last couple of years. So where there is truly undervaluation, you'll get great return opportunity. Where there is overvaluation, you won't get the same level of momentum hype that you've had.
So the earnings seasons will be reality check for the valuation. Some of the most powerful secular trends that we see, which accelerated during the COVID, are going to look back for a while in the near term when compared. They simply won't have the growth rate compared to their booming last year. For investors, what to expect there? What are the sectors, companies you see such hiccups and trends that you believe in?
Okay, so I think there are some clear buckets of names that are vulnerable. So working from home names, I think, are still quite vulnerable. Clearly, they have had a quantum step in terms of their ability to establish themselves and stamp their mark. A company like Zoom is not going to go away. It might well have done if we hadn't had COVID. It may not really have existed in anything like the size or form that we see it today. But I don't think for 1 minute it's going to be the dominant provider of video conferencing technology going forward. There's just way too much competition. So working from home names, I think, are still vulnerable. Some of the online, what I call Me Too names, companies that have done well purely because online has been the only way to do things. There was a long period of time where the only way you could buy what you wanted was to go and buy it online because you couldn't walk into a shop. So some very basic online businesses have done well. And I think we will see those basic online businesses that don't have more than just a kind of basic retail element also struggling in a world which is going to be dominated by omnichannel. It's going to be the ability to have your products sold not only online in the usual way, but also offline and also in the metaverse. So those companies that are not innovative will struggle.
Mhm.
Um, and then the third area, which I think is going to be very interesting to look at, is more traditional technology. So there's been a view built up over the last 10, 11, 12 years in what has been a pure bull market that things like semiconductors are now growth companies. And I can be pretty certain that they're not. They may be less cyclical than they used to be because they are beneficiaries of some of the key drivers that are going on at the moment. But when
Mhm.
we get a downturn in the economy, and we will get one at some point, those are the sort of companies that will see revenue decline. They are not structural growing businesses through every market condition. And that will remind people that paying 50 times for a semiconductor company is maybe not the wisest thing to be doing.
Oh, that's a very interesting point. So how do you factor that into your portfolio to ensure high multiples are for good reasons? How do you cherry pick where you spend your time? Could you give us some examples?
Yeah, so I go back again to the grounding that we have. We
Mhm.
basically, our process is grounded in, from a single stock point of view, in our intrinsic modeling. We use DCF modeling. We tend to model out for as much as 10 years um, on a carefully based basis, and then some kind of termination rate or some kind of termination multiple. We might even model out further than that. Um, and it's that which drives, is this expensive or is it not? Um, and what we're finding is that businesses that are into this on this slide here, as I say, the businesses that essentially drive the fourth digital wave in some less traditionally disrupted sectors give us, I think, some of the most interesting opportunity. And part of that is the fact that I think the market's not on top of the opportunity. So we have a company in the portfolio called Sensata. It's the world's largest manufacturer of pressure and heat sensors. They go into commercial and consumer vehicles. Now, they have now launched a software product that sits on top of the sensor product and delivers fleet owners and car manufacturers a lot of data about the way that those sensors are delivering value. And that can be used to enhance the way that fleets are managed or the way that cars are manufactured. This is a totally new line of business at double the margin of the traditional sensor business, and most analysts don't model it. So by looking at the next wave, that's where we find a real delta often in our outlook for the growth of these businesses. We try to find businesses that are growing faster or more profitably than the market expects by using this disruptive lens, and then using the DCF methodology to ensure that having modeled that, we're then paying a price which represents an opportunity for a decent return.
Mhm. So our next question is rather about timing, particularly in disruptive tech or e-commerce sector, where market often overreacts or to exciting new development or forced to the hype cycle. How can investors benefit from such behavioral bias and to position across those phases? How do you test where you think investors may be too early or too late to a trend or theme?
So I think the key here is exactly as you have just laid it out. It's a hype cycle. Every new technology follows a hype cycle. So what one needs to be doing is deciding where we are on that cycle. Now, it was very much sort of from an academic point of view has been formalized by Gartner, the business consultancy, and they see every new technology having a hype piece. You rise up to a peak of inflated expectation where often share prices in this case exceed a value which is fair for where the business is. Often those businesses tend to go through a failure period first, and therefore you see a huge sinking down into a trough of disillusionment. And from that trough, you start to get the much longer term, perhaps steadier growth opportunity. So you have, in a sense, four phases to think about. Are we in the hype cycle? Do I want to be a part of it? Are we in the fall from the peak of inflated expectations? And do I want to make sure I'm absolutely not a part of it? How long is the trough of um, disillusionment? I would argue, for example, in a lot of internet companies, that lasted from the dot-com boom bust in 2000 right through to 2006, 2007. So that was 7 years in the wilderness. And then are we in the slope of enlightenment? So we look at all of our ideas on that kind of blueprint and decide where we are. And I would urge all investors to do the same thing and decide which parts of that cycle they want to be involved in and which parts they don't. But above all, to be very conscious of which part they're in. Solar is a great example. I always go back to 2005, 2006. All these solar panel manufacturers started coming to the market, and there were two big companies in Germany, Q Cells and SolarWorld. And when you read the prospectuses for these companies, you realize they spent nothing on capital and they spent nothing on R&D. So what made them so special? Well, the answer is they weren't. It was a commodity business. It got completely taken to the cleaners by cheap Chinese manufacture, and ultimately both those companies went bust essentially. So you've got to know where you are on the hype cycle in deciding how and when you invest.
Mhm. So are you back on the road yet? Has the team started company visits and talking with the management? What are the message you're getting from them? What are the impacts, especially regarding the supply chain constraint? How do you invest around that?
Okay, so the answer is yes. I did my first trip for 2 years to California
Mhm.
2 weeks ago. I normally go at least twice a year and haven't been able to.
Mhm.
And although we can have meetings on video call, it just isn't the same. To give you one anecdotal, quite amusing
Mhm.
story. So I went to visit uh, a company in San Francisco,
Mhm.
and the company was a DSPAC. It had been DSPACed, and it was in title insurance. Um, and the CEO was obsessed with the fact that many companies that are de-SPACed were not being rewarded by the market because they had this kind of black mark on their names by being de-SPAC candidates. And he had looked at a whole lot of them and he reeled off half a dozen companies that he thought were very cheap and really interesting. Now, there is a field of ideas that I can go and look at. If I did a video call with him, it would be absolutely on point. It would be to a much more scripted um, recipe. So you learn so much
Mhm.
more by being actually out in the field. So that was good.
Yeah.
The feel and the feedback. Companies are still very positive about the disruptive trends we're in.
Mhm.
We're seeing very little, or they are seeing very little in terms of changes to growth profiles. Um, there's definitely a focus on the opportunity that the metaverse offers, and we've started to look at that. Indeed, we've begun to invest in that as well.
Mhm.
But the key, I think, is that the mood is still very positive,
Mhm.
and whilst again, some companies also accept that valuations may have become excessive in places. It is a case of what you pay for the company, not how the company is doing. There's nothing to suggest at the moment any kind of change in the growth profile for these themes or these companies.
Mhm. What is the hottest like buzzword in the valley right now?
I think it's probably metaverse.
Metaverse.
But it's not metaverse in the way that Facebook want us to have it. Have it. It's not everybody wearing virtual reality headsets and bumping into lampposts. It's a kind of a more immersive experience. So just to give
Mhm.
you a really good example of this,
Yeah.
so Gucci have launched a virtual store on the
Mhm.
Roblox platform. They've had 20 million visitors to that store, spending
Wow.
on average quite large 30, 40 minutes worth of time going around that store.
Mhm.
Now, they say that is a 3D experience compared to the existing way that Gucci can promote itself in doing things like a 10-second video on Instagram or having a Facebook page. So it's the next phase of immersion and the way in which we'll deeply enrich our experience in the online world. It's not about everyone wearing headsets. I'm sure that will be a part, but that really is not, to my
Total
mind,
loss.
what the metaverse is about.
Yeah. Oh, so in the last few
Yeah.
months, we've seen we've seen crackdowns on tech companies in China, where the government was trying to break off the monopoly of country's big tech titans and to keep sensitive consumer data, biometric data within its borders. What's the implication of overall market? What was done and what has changed, in your portfolio in the wake of potential targets for the regulatory reset? Have we seen the worst yet? What to expect in 2022?
Okay, there's a lot of questions wrapped up in there. So, firstly, I think that the regulatory environment clearly reached a peak with the banning of for-profit education businesses.
Mhm.
Noises had been made quite a long time before that, and we had begun to reduce some of our exposure. When that happened, and around that time, we took a view that there was a lot of risk on B2C businesses.
Mm.
So broadly, the main sort of online platforms like Alibaba and JD and Data Nexus and these kind of companies. So we pivoted. We did two things. We reduced our exposure on the one hand, and we pivoted from B2C into both B2B and companies that we call uh, government tailwind businesses, like EV, for example, or environment. And so those two things together were the first stage of change that we made to the portfolio. Um, we still think there's a lot to come in terms of regulation, more because there's just not clarity yet. And so we think it's too early. Is the worst over? The worst is probably over, but are we at the bottom? I don't necessarily think so. So
Mhm.
we're being very patient. We think it'll be next year before one can really become clearly more positive. There is a huge amount of pent-up opportunity, I think, in these companies. And the latest piece of the jigsaw, which is really important to understand, is this delisting of ADRs, because
Yeah.
this is a combination of emphasis from both the Chinese authorities and the SEC.
Mhm.
We're in a situation now where US investors are very concerned about where they will stand as owners of ADRs. In many cases, as Didi pointed out on Friday, they will launch a Hong Kong listed version of the stock. It'll be possible to switch from ADR to Hong Kong. And then ultimately, if there's a delisting of the ADR, the investors have had continuity. But there's an awful lot of stuff that happens in between that in terms of the technical picture. There are
Yeah.
many US investors who can't buy Hong Kong stocks.
Exactly.
ETFs, for example, ETF holders of ADRs are likely to have to be forced sellers. So our
Mm.
belief is that on the ADR side, there's still a lot of selling pressure to come. It won't be absorbed fully by the current Hong Kong listed versions of many of those names. And so that also is an uncertainty. And until that has seen its way through and washed through, we're reluctant to be too involved there either. So our
Mhm.
basic mantra is smaller positioning, focus on the sectors the government is keen on, which is broadly speaking EV, AI, and environmental. And at some point next year, there will be an outstanding opportunity to raise the exposure quite significantly again to China, but we need to be patient.
Mhm. So, as you mentioned, there's a tech cold war between U.S. and China in the EV sector, in the semiconductor, that you touched base on the semiconductor part. So decoupling and tech cold war are the key words when we talk about U.S.-China relationship in the beginning of this year. How is tech rivalry between those two largest economies and chip supply shortage that we're seeing now shaping the electric EVs and the semiconductor sectors? What are other areas of opportunities there?
So I think the reason there's a cold war here is that for the first time, again I go back to the slide which is on the screen. China, for the first time in this fourth digital wave, I think has a chance of being a global leader. Data is going to be, in a sense, the new oil, and AI is the new tractor, car, truck, whatever you want to call it. So, fed with lots and lots of oil, AI can perform really well. China has a huge data set. They have 2 to 3 times the number of smartphone users of any other country in the world. They have a much higher degree of AI within their app economy than other countries in the world. And that frightens the Western world. And so that's why this Cold War has really kind of intensified. It's why the West wants to be really careful about what technology it does allow China to use. It wants to be very careful about what technology China places in the Western world that it might benefit from in terms of stealing data. And so I think it's going to be an ongoing, evolving situation. I think it's not directly related to the supply chain issue, which I think has different features. Um, and that I think, you know, there are always times when you have a supply chain issue. It's not caused enormous damage yet to the economies or to companies' prospects. I suspect the bigger risk for the supply chain ultimately is that because of the scare, companies have been double or treble ordering chips. And so when things ease, we'll have a lot of companies who have way more chips than they need. And that could be the catalyst for a downturn in the semiconductor sector.
Mhm. Great. So I'm sure there's still a lot of interesting points we haven't covered yet, but unfortunately, in the interest of time, we have to stop here. A very big thank you to our guest speaker, Mark Hawtin, today for being here with us today and for the insightful talk. Thank you, Mark.
Thank you very much. It's been really enjoyable. Thank you.
So I hope you all enjoyed our Portfolio Manager Conference today and leave better informed. Have a wonderful day and see you next time. Stay healthy.